Welcome back to another episode of Building Up Your Podcast. I'm your host, Erica Dill. From bomb to order fulfillment, taxes to marketing, learn the stuff here before you step in it. And I'm really excited about today's guest speaker. Kristy Melton is with us. She's spent her career as a small business specialist and advocate in multiple capacities. And now she is a commercial finance broker with Heritage Commercial Funding, where she specializes in helping small businesses with alternative funding options. And I'm sure, especially with the way things are right now, everybody wants to know what types of alternative funding is out there. So that's why she's here today to talk about our topic of the best financing options for small businesses. Kristy, thank you so much for joining us.
Yeah, of course. Thanks, Erica. Thanks for having me.
So let's just jump right in because I'm sure this is going to be an episode people can't wait to listen to. So what are the main types of financing that are available to small businesses?
Yeah, I think there's really three buckets of financing options available to small businesses. The first one would be considered private investment. So that would be, just real simply bootstrap money, businesses bringing in their own personal savings into the business, friends and family money. That would also include any type of VC or angel investments that businesses get, or if a business was to go public, that would also fall under private investment. Then the second bucket would be traditional bank financing. So everyone's familiar with that. Wherever they have their depository accounts, or just walking into a Wells Fargo, Bank of America, or even a community bank and applying for a business line or loan to help the business.
Old-fashioned loans.
Correct. Yeah. So traditional bank funding. And then the third bucket is alternative funding, and that's what we specialize in at Heritage Commercial Funding. And alternative lending is really any type of loan options that are available to businesses outside of traditional bank financing. Now, most businesses would opt for alternative funding if they can't qualify for traditional bank financing. So we do work on a lot of cases for businesses that have been declined by the bank. But we also have some customers that could qualify with the bank, but they choose alternative funding because these lenders don't have as many covenants. Their restrictions are a lot less, and they can fund really fast. So some of our customers will choose to fund with one of our lenders because they can get it done quickly and then maybe refinance with a bank later.
Interesting. So I think we all know what a traditional investor is, or bringing in our own money, so we can kind of set that one aside. But,
Right.
you mentioned traditional banking versus kind of this more creative alternative funding. If I wanted to go to a bank and get a traditional bank loan, what types of requirements would be part of that from the bank? What would I need to do to meet that criteria?
Okay, yeah. I obviously don't work for a bank, so these are just things that I've learned over the years and have picked up on. But if a business is applying for traditional bank financing, some things that I've come to understand are very important, and I'm sure a lot of my business banking friends could attest. Time in business. Most traditional banks are looking for businesses that have been around for at least 3 years, so they can see that track record with the business. Banks are also looking for profitability. They want businesses that are showing profits on a consistent basis, showing that they're making money, and they can do that again consistently. They're also looking for strong both business and personal credit scores. So that's important. They're looking for a strong business plan and strong financials, and they'll want the business to be able to present a full package. So that's really important for them to be able to go through. A lot of banks too have certain preferences as far as industry. So sometimes we get referrals to businesses that are in industries that the banks aren't necessarily comfortable with. Like we tend to get a lot of referrals for contractors, let's say, because that's a business that's considered pretty high risk that a lot of banks don't want to necessarily get involved with. But that's just one example. banks don't necessarily like businesses that are in a rapid growth phase. I had a banker
Yeah, I
tell
was
me
just
one
thinking that.
time, if a business is growing more than 10 to 15% a year, that can be considered too aggressive for traditional financing, because a lot of businesses may not be adequately prepared to handle that kind of growth.
Yeah.
And so that could be something that the bank would shy away from, and a reason that a business would need to, at least for a short time period, while they're on that rapid growth curve, consider alternative funding. And then banks also don't like concentrations. So if a business has uh, some concentrations, meaning that they have too many eggs in one basket, according to the
Oh.
bank, so to speak, that can be something that would be a
So,
concern.
like, if they have a customer that's 60% of their business, that's too much of a liability for them to
Correct.
invest
And
in.
I'm not saying that the banks aren't justified in regards to a number of these things.
Yes.
But that doesn't mean that some of these businesses, don't still need support,
Right.
or aren't still looking for capital. And there are still lenders that, in the right scenario, can provide that option.
Well, and I'm thinking of kind of some of these high growth, really successful companies that have, a great executive team that's leading them, that's on a really great path. But, yeah, they're growing maybe 15% or more year over year. It doesn't mean they don't need funding, doesn't mean that they're going to fail. It just means that they're not going to be eligible for bank loans. And specifically, if we're talking in a consumer goods world, you're going to need that funding to finance your inventory to meet that demand. And that's probably going to be one of the biggest problems to failing, is if you can't finance that inventory and you can't grow at that rate. But traditional banks are probably going to look at you and be like, too risky for us, it sounds like.
Correct. I mean, cash is king. So, yeah, they do need to get their hands on some working capital. And if their margins are there to support the alternative lending rates, then it doesn't make sense to walk away from that business because they don't have, the cash to support it. So these are the types of conversations that I have. And then, when their growth stabilizes and when they can qualify for a large enough line of credit at the bank, typically, the lenders that I work with don't require any type of long-term commitment. So then they would transition into, some type of facility at the bank when appropriate.
Awesome. Okay, so that makes more sense. So then talk to us a little bit about how this alternative funding works, and what are the requirements, and how does it function?
Yeah, so alternative lending, most of the deals that I work on are some type of asset-based lending deals. Asset-based lending deals are underwritten primarily on collateral rather than cash flow. And the best type of collateral that lenders like to lend against is accounts receivable.
Okay.
Um, and and with accounts receivable, um, the reason that it's so powerful is that a business that is even a startup can be approved for funding, because the credit decision is primarily based on the creditworthiness of their customers rather than on them. So it can be, again, a new business, it can be a business that has been losing money or different issues. But if they have solid contracts, and if they have invoices outstanding to really solid companies like a Costco or something like that, and the lender can verify that, they're going to feel comfortable giving them an advance on those invoices, because the true repayment source is not the new business, it's Costco.
It's Costco, it's Target, it's and does it only have to be like the big box retailers that those fundings can come, that they could be fundings can be rely on?
No, these lenders have really expansive credit search databases, and
Gotcha.
sometimes you'd be surprised. Sometimes businesses that you think, are big and really well known will actually come up with a not so great credit score, and then some businesses that you really haven't heard that much about will come back with a really strong credit score. And so the lenders are able to give you that information and then let you know which ones they would feel comfortable advancing against or including in a borrowing base and which ones not. And actually, I've talked to some of my customers that that's really a hidden benefit of this type of lending, because a lot of businesses are not really aware what type of businesses they should be offering payment terms to. And in essence, they're being a bank to their customers. And why would you offer payment terms to a customer that is really high risk, a chance of going belly up? So if you're working with a lender like this and the lender tells you that they're not comfortable advancing against them, then that's probably a customer that you should require COD from, that kind of thing. Just because
or
that the
at least a
lender's
deposit.
correct, something. Yeah, because if the lender's not going to take the risk, because the lender wants to make money too, then I certainly don't think a newer business should take the risk. But then if the lender is comfortable, then you know that that's a client that you can feel comfortable with. And then obviously if you have the backing of the lender, you can feel extra comfortable because you're going to have the cash flow support from the lender as well.
Gotcha. So can they get access to this list, or do they have to work with a lender in order to get access to these super secret credit score lists?
Well, they do have to be, they do have to work with a lender, but in the initial underwriting process, when the lender's deciding whether or not they're going to take on a new client, they will let a business know what their appetite is for their accounts receivable, if that makes sense. Yeah.
So they'll get a good feeling up front. It won't be
correct.
One of these, like, you have to go through this whole process and try to figure it out at the end. They'll know up front, like, hey, your customers are stellar, and this, these customers are going to be okay for us to potentially lend with.
Correct.
Lend based off of, I should say.
Exactly.
Gotcha.
Yeah.
And so you're talking like this random .com website that you could be selling to might actually have a better credit score than Target.
In some cases, correct.
Interesting.
Yes.
That's kind of scary, I guess.
Right.
People who think, so many times do people think, oh, I'm selling to this well-known brand, it's not going to be a problem at all. I don't think anybody's actually thinking, hey, this might actually be a situation and I might actually want to go with some of these lesser-known people. So I don't think people have know that. And I think the other thing that's really interesting is that this lending isn't based on the company. It's not based on, your specific company or as far as like our customers, our listeners. It's not based on their company and their performance. It's based on the accounts receivable that they have. So that takes a lot of pressure off of them. I know when you go through that traditional lending process, people lose hair and years of their lives trying to get their business plan together and their financial plans and their P&Ls and everything in tip-top shape, because, spoiler alert, most listeners probably don't have a business plan that they could hand over to somebody right now.
Well, that's the thing. Yeah, a lot of times, I'll talk to businesses, and because we're not tied to any one lender, I'll talk to businesses and, be explaining to them what different lenders will be asking for as far as an application. But if they don't have some of that information ready, then that will dictate which lenders I would be able to take them to, based on what the lenders require, if that makes sense. But luckily, I do have options in my network that don't have such extensive requirements.
Well, and that's what I was going to say. You seem to be like the best person for people to go to and be like, here's my situation. Where do you want to point me? Because you could be like, not going to work, not going to work, not going to work. However, you should go talk to these 2 or 3 people because they're probably going to be best suited to your situation.
Correct. And it logically makes sense that the more they would allow a lender to dig into their business, the more financial information they provide, the better rate they're going to likely get. So I would encourage that. But if they need funding relatively quickly and they don't have that information together, then I can say, hey, this is the best that you're going to get right now. And then you can, even within alternative lending, you can refi into something, better as soon as you get this information together. You're always trying to move up the continuum, if that makes sense, of what's available. And then I don't charge anything directly to the businesses that I work with. I'm a licensed broker. I'm contracted with the lenders, and I get paid by the lender, not the business.
Gotcha.
So again, I would present what is available to them right now based on their financial situation and what information they would have available, and a lot of the things we've been talking about right now. But then the ball's in their court with what makes sense.
Gotcha. Okay. So that's nice to know that no matter what situation they're in, you present options and they get to go with the best option that suits them. And they don't have to worry about how much, what your cost is going to be on top of this situation. So,
Correct.
so, this has all been incredibly useful, and I'm sure there's been listeners that are like, holy cow, I had no idea about any of this stuff. Where can somebody reach out to you and ask you more questions or get a hold of you? What's the best method?
Yeah, I'm on LinkedIn, so I would love to connect with people there. I also have a website, so please find me on my website, and there's a contact us page. And I think you have all of those details that you can send out with links, correct?
Yeah, so we'll put your website, we'll put your LinkedIn in the bio and the comments below, so that if anybody wants to reach out, has more questions, or thinks they're even ready, they can reach out to you and get a hold. And I'm sure somebody's got a million of questions about alternative funding because they probably haven't heard of it before. So thank you so much for being with us today, Kristy. This has been a load of information, and I think I even learned something new today.
Oh, great. Yeah, well, thanks again for having me, and happy to be a resource. And hopefully we'll get to connect with some people.
Absolutely. So thank you for watching another episode of Building Up Your Podcast. I am your host, Erica Dill with Operationally Up, and we've got a lot more episodes coming at you soon, so we hope to see you there. Thanks. Have a great day.